This is a review for December 20th, 2024. We had a really important pattern and it was a breakout below bear channel. I'll just zoom this out. So if you guys wanted to pause this and look at those, you can. But we had a really important pattern and it started over here yesterday. Remember, what's the market cycle, right? The market cycle is important. Spike, pullback, channel, trading range. And obviously trading range ended up turning into a bull trend, but we had a really important pattern here, and that is a breakout below a bear channel. Whenever you get a bear channel, especially one that lasts, 50, 60, 70 bars, and the next day is trying to break out of it, there's an increased chance of a reversal. 75% chance that a breakout below a bear channel is going to fail and try to test at least the other side of the channel. So you have to figure on the open, you can draw the line however you want to draw the line. I would personally draw it something like this, somewhere in between these two. This is an overshoot in my opinion, but we have potentially, the high, that high. You could use these ones, but it's difficult to draw. Somewhere in here, though, it doesn't really matter. It's a generality. So as long as your bear channel line is somewhere in here, when you get this breakout below, it's 75% chance the breakout is going to fail. The question you have to be asking yourself, the question you should always be asking yourself during trading is, what would the bear breakout look like if it was going to succeed, right? Well, if the bear breakout below the channel was going to succeed, it would be part of that 25%. So you probably want to see pretty strong bear bars closing near their lows. 3 and 4 is not that, especially after 1 and 2. Bar 2 dramatically damages the case for the bears to get some sort of breakout below the bear channel that's going to be successful. So you have to keep in mind, again, a breakout below a bear channel, that's also the second leg down from this, right? When you get something this large, it's obviously going to get a second leg down. What does the second leg down actually mean? It means we will probably go at least one tick below the low. So traders were expecting that we would at least go one tick below Wednesday's low at some point. And it came in this breakout below the bear channel, and this essentially ended up being a second leg trap for the bears on a higher time frame. Something else to keep in mind is, what do you notice about this day in relation to this sell-off? It's an inside day, right? And what are inside bars? Inside bars are low ones and high ones. So I'm going to pull up the daily chart because the daily chart gives context for the actual day. So what do you notice about this bar? That's an inside bar. Well, you notice that it's a low one short. So we have a bear breakout, and this is a low one short. Why is that important? Because low one shorts and high one buys in general lead to pullbacks and then second legs down. So as much as traders look at this low one short and think, oh yeah, big sell-off, we're probably going lower, it's usually going to lead to a pullback if the market's in some sort of trading range. And I think this is your hint that we're probably in some sort of trading range, the fact that we got a pullback here. The fact that this didn't close on its high, I'll get into that later. But interesting that this did not close on its high. That's all I'll say for now. And I know, the argument that you could say to me is, well, Jake, if, inside bars are low ones and high ones, and they usually lead to pullbacks, what about bar 14? What about bar 14 today? That's an inside bar, and the trend continued. That's because it's in a bull trend. So if you're in a strong trend, high ones and low ones are acceptable, especially in the first leg of a bull trend, right? So 9 through 15, first leg of a bull trend, increased chance that we're going to get some sort of strong second leg up. So okay to buy above 14, expecting a second leg up, especially with a wide stop. You probably don't want to trade high ones and low ones in third legs or trading ranges or anything like that. Those are more areas to fade those. With that being said, start the review. Bar 1, a bull bar, but a small tail on the top. It's okay to buy above 1 simply because the context is really oversold and it's a failed breakout below yesterday's low. So you could buy above 1 and take a chance that we get a big bull trend day. Obviously, you would have been stopped out here, which is disappointing if you did that. But that's just kind of trading on the open. You're going to get trapped out. And so some traders could buy above 1. I would personally probably wait. 2, good looking follow through bar. So you could buy the close of 2 or try to buy above 2. Disappointing that we did not trigger above 2, but still consecutive bull bars, and 2, a strong bull bar closing near its high. I think 2 makes the market always in long. 3, a bear bar, but a large tail on the bottom. Again, I still think we're probably going higher. I think we need to test the 2 close at some point. So I'm more interested in seeing what happens when we rally back up to that point. 4, consecutive bear bars, 3, 4. big up 1 2, big down 3 4, probably confusion, and buyers below 1. 5, a bull bar, so it's a lower low double bottom. 1 5. Can you buy above 5? It's kind of similar to buying above 1. It's probably a little bit better because it's a second reversal up, and we need to get back to that bar 2 close because the bar 2 close is a magnet. However, the thing you have to remember is that 3 and 4 is reasonably strong, and so the market's probably going to try and trap you out. If you're buying above 5, it's a lower low double bottom, and the second reversal up has a tail on the top. So you have to understand that you're taking a chance, and it's probably not going to be super clear for a little while. It didn't become clear until 9 is kind of clear, but it could be a third leg, and it's big risk. So you probably want to wait for like 11 or 12 or something. But you could buy above 5, taking a chance that it's the low of the day. If you're doing that, you cannot be exiting below bars like 8. You can't be exiting on the close of 6. You just buy, you put your stop below, and you just sit there and you wait. If you can't watch, then you go to Walmart, you go do something else, you go watch a TV show, and you come back in 30 minutes and maybe an hour and reassess your trade. 6, a bear bar, but a tail on the bottom. Not really a great short. Probably buyers somewhere below here. Again, if you sold the close of 4, 5 is really disappointing. You're probably going to start trying to buy back shorts around 6. 7, a big bull bar, but not really that great. There is a small tail on the top. Doesn't really matter, obviously. It's a bull bar closing essentially on its high. It's good for the bulls. Is it higher probability? Yeah, it's a little bit higher probability than buying above 5. But if you buy above 6, 7 is really disappointing. The problem with 7 is that it's probably still more of a swing trade. It's just your percentage has maybe increased from, 40% chance to a 45% chance or something on 7. So buying above 7, a little bit of an increased chance of a measured move up. 8, a bear bar closing near its low. Do you sell below 8? No, I would not. It's a double top. 3, 8, it's a lower low double top. So 8 is lower than 3. However, 2, big bull bar closing near its high. 7, bull bar closing near its high. And again, this is why context is so important, because the breakout below the bear channel. If the breakout below the bear channel is going to succeed, 9 is going to be the opposite of what it was. It's going to be a massive bear bar closing near its low. 10 is probably also going to be a massive bear bar closing near its low. And it's just not necessarily all that likely that that's going to happen. And instead, we get buyers below 9, so traders willing to buy below, taking a chance that we are in fact not going to get a breakout down and we're going to get a reversal up. And then 9, a bull bar closing near its high. 9 is a credible buy and it's higher probability. The only issue with 9 is that it's a really big bar and it's possibly high in a trading range. But given the fact that it's a breakout below a bear channel and it's low probability for the bears, it's probably good to buy the close of 9. You could probably put a stop below 9. The only issue is you might sit through a pullback sometimes, so you might want to wait for higher probability. I personally waited. I bought the close of 12. And you might look and say, oh, you gave up so much profit. And maybe, but I had much higher probability. Here, 60% chance of a second leg up, maybe 65% chance of a second leg up. Here, 80 to 85% chance that I get a second leg. Doesn't mean 85% chance that we do this. It means even if we pull back and get a deep pullback, 85% chance we're going to get some sort of second bounce and I'm going to not lose money on the trade. So I like the high probability trades. So nothing wrong with buying above 9. It's a good trade. But you have to understand, you have to have good calibrated expectations. If it starts to go sideways for too long, you have to be willing to exit. So if you bought above 9, what are you looking for? Well, you're looking for some sort of good follow through on the next couple of bars. You want some sort of bull bars closing near their highs. What about 10? 10 does something that's extremely important. And it's, what do bull trends have, right? So I'll start with that. I'll kind of hint at it first. So what do bull trends have? Bull trends have open gaps. Well, what is the open gap that 10 creates? If you look, the 8 high and the 10 low is an open gap. Why is this important? Because as a bear, in general, if you're in a trading range, you can sell above bear bars and expect to make money. In a trading range, for the most part, if you sell above a bar like 9 or a reversal bar like 9 and you're willing to scale in, you're probably going to make money. However, the bears who sold above here, who saw that 9 close on its high, if you think about it, when you see 9 closing on its high, you don't love it if you're a bear. So you probably just try to get out at break even. They were never even let out at break even. And then we started getting bull bars. And so the bears who sold above here started realizing they were trapped and having to buy back their shorts. So when did that happen again, right? When was a time where the market was probably supposed to go sideways and then it ended up getting a breakout above? That would be bar 18. you can see bar 18, a bear bar, not a good short below 18, way too much bullishness. We're going to go higher. But when you see 18, in my mind, I think we're probably going to go a little more sideways first. We're probably going to get 5 to 10 bars, maybe another 5 or 6 bars sideways and start a bull channel. And instead, we get 19, a big bull bar. So the bear who sold above here is hoping the breakout's going to fail. And instead, we get another open gap. So the bears who sold above 18 get trapped immediately. And that's what causes this second rally to go a lot higher. So 11, a bull bar closing near its high. Big, small, big pattern. We might pull back, but again, I still think that it's really strong. 12, another huge bull bar, 4-bar micro channel. Buy the close, buy for any reason. 13, another bull bar, a tail on the top. So a little bit less likely we get a crazy vacuum test up, but still there's no reason to sell. Again, like I said, 80-85% chance we get another leg. 14, an inside bar, low one short, or high one buy, sorry. It's reasonable to buy above 14. Buy the close, buy for any reason. You see something like this with this kind of context. Al writes in his book, "Did it rain in the Amazon this year?" Then yes, then buy. Did someone score at your kid's youth basketball game this weekend? Sure, then buy. Make up a reason in your mind. It doesn't even have to be related to trading. But when you see stuff like this, just make up some question where the answer is definitely yes, and you just buy more. On every bull bar, you just buy more. Oops. And you're going to find as your probability, yes, your risk will get bigger, but as your probability increases for making money, you can add and add and add. And then eventually you get a bar like 19, you can move your stop and you have a bigger position. So 15, a bull bar, again, part of a bull spike. Bulls at this point, just looking for a measure to move up, essentially waiting for the spike to end. 16, an inside bar, a high one buy for the bulls, but might lead to a pullback first since it's a bear bar. 17, a bull bar, but not breaking out above the 14 high. 13 high, still okay to buy above 17, but you just need to have good calibrated expectations in that we're probably going to pull back. So you can buy for any reason. You could have bought the high tick of 18 during 18. That's fine, so long as you know that any reversal is going to be minor. 9 through 15 is so strong that the first reversal is not going to go anywhere. 19, a big bull bar closing near its high, or I shouldn't say it's never going to go anywhere, but low probability. So if you want to be on the high probability side of things, you buy below 18 and basically bet on it failing. If you're somebody who's shorting bars like 18 and you feel like you're constantly losing, well, you're eventually going to get to a point where these trades that you're constantly losing, you're going to recognize them in real time and you're going to do the opposite. And so you'll buy below 18 because you know that the trader who buys below 18 gets trapped because you've done it. And that's I'm very, so I left off on 18, but I'm very guilty of that in a lot of ways. One of the things that I used to do back in the day was I would buy above bars like 53, betting that it was some sort of wedge and not recognize the tight channel, and I'd buy above. And then, I'd basically get stopped out below and reverse my position below 54 because I thought 54 was such a big breakout bar. And, we're certainly going to go lower. And then I'd get stopped out again and I'd be confused and upset and lose a bunch of money. And yesterday, what I did, I know that 53 is a big bull bar, but I know it's a tight channel down. So I'd imagine where I'm going to get a chance to buy below 53. So when I saw 54, I know that selling below 54 is bad because I've done it a bunch of times. And I know that 53 needs a second leg up. So I bought the 53 low. I'll go over my trades briefly. I bought the close of 12, got the measured move. I bought below 53, basically knowing that 54 is low probability. And basically, if 55 and 56, my rule for myself was if I got some sort of strong consecutive bear bars, I could get out. So if we got any sort of good looking bear follow through, then I would just get out with a small loss. And instead, what happened was I bought and I held, and then I scalped out above the 54 high. Why above the 54 high? Because I know that there are bear stops there that should get run. And I know that, 53 into the tail of 54 should get a second leg. So when I say 53 should get a second leg, I mean it should get one tick above the 54 high. The only other thing I did, which it wasn't great in hindsight, so this is a 4-bar micro channel, and I usually would not take 4-bar micro. The time where 4-bar micro channels are usually not very effective are the end of bull trend days. So when you get a bull trend, a pullback, and then a 4-bar micro channel, it's usually not very effective. And same thing against a tight channel. So this had all the recipes of not going to be a very effective trade, except for the fact that we had essentially, a 100+ point rally on the open. So I made an exception and I did buy up here and I took a loss. Basically, I gave back everything I made on this trade, And I just had my profit from this earlier measured move, which was fine. I don't really have a problem with it. I thought it was okay. I probably could have exited the trade earlier. I ended up getting out down here, and I probably could have exited below this, but I thought it was reasonable. I thought it was low probability that I get trapped, but that was all I did that day. So 19 or this day, big outside up bar on 19, closing on its high, trapping traders who sold below or above 18, and then 20, a doji bar, follow through, but still a doji bar. And then 21, big, small, big, possible we pull back, but you're trapping bears who've sold above 18, so they might have to start getting out soon. Follow through by the close, 23, 24, 25, 26, bull bar. You can still buy the close of 26, but you have to keep in mind that when you get something this climactic, 60% chance it's the end of the bull trend, and 60% chance you get a pullback. 60% chance the end of the trend, and 60% chance of one more leg sideways to up before you start to pull back. So you can see if you bought the close of 26, you could have made money, but not a ton. 27, consecutive bull bars, 26, 27. 28, an inside bar, a bear bar, low one short, probably buyers below. 29, the bear bar, but a tail, and probably not going that much lower. We do have an open gap over here. Oh, this is another trade that I took yesterday. I forgot to mention, and this is a good point with calibrated expectations. We started to get this sell-off, but it was probably going to be minor. So I would imagine that there was going to be buyers somewhere down here. And you can see on 47 or 46, we came down and we touched the 25 high. I bought the 25 high during, it touched it on the SPY at least. Had I known it didn't actually touch it, I might not have gotten filled. But I bought down here, and then 46 got bought up, and I was hoping for a bull bar on 47. Instead, we got this bear bar on 47, so I just exited at break even. And that's a good example of calibrated expectations. I bought during 46, and I wanted 46 to look like this, and it did, so that was good. And then I wanted a little bit of a bounce somewhere up into this area, maybe towards the middle of this, and then I was going to get out somewhere up here. And then instead we got that bar. And so I just exited at the market, and I think I lost basically a tick or like 2 ticks. So really, on days where the bars are 15, 20 points, losing 2 ticks is obviously very small. 29, 30. So I think I'm 30, second leg up, back up to around the 27 close. An inside bar, 31. Probably sellers above, scaling in higher, but big bull trend. It's looking like a third leg up, first leg up to 15, second leg up to 27. And we're starting the third leg up, so it's not as good as it could be. 32, 33, 34, 3 straight bull bars, probably buyers below, but you have to be wondering how much higher we're going. 35, buyers below 34, and then 36, big bull bar. A lot of bulls exiting on the close of 36, causing the big bear bar 37. Do you sell the close at 37? I probably would not sell the close, but to me, 37 is the end of the bull trend because it's a big bear bar that needs a second leg. You don't really get, if you look at the whole rally, a ton of bear bars that needed a second leg up until 37. 38, a bull bar, but not really that great to do anything with after 37. 39 could be the second leg down, but I still think if we test the 36 close, there will be sellers. 40, bull bar, you could argue high too, but this is the bull channel. It's a weak bull channel because the spike was so massive that we're probably going to go sideways the rest of the day. Whenever you have a spike that's this massive and it lasts, if it lasts 15 to 18 bars, I usually expect the second leg. If it lasts like 27 to 30 bars, I usually expect us to go sideways the rest of the day. And again, this is a pullback. It's a bear channel, right? So spike and then weak bull channel. This was probably, if you wanted to divide up the market cycle, you would say the spike lasted up until here. And then this is the bull channel to here. And then this is a bear leg in a trading range, and we'll probably get a bull leg in a trading range Monday. So 42, a bear bar, a lower high double top. It's not like I would sell it, but not great to buy. 43, 44, 45, 3 straight bear bars, but shrinking bodies to the moving average. 46, a bear bar, but a large tail, probably buyers scaling in lower. 47, consecutive bear bar, again, large tail, probably buyers below scaling in lower. And 48, a big bear bar closing near its low. What do you notice? What does this price action indicate on a lower time frame? A parabolic wedge. So down on 46, up on 46, down on 47, up on 47, down on 48. So if 49 is a big bear bar closing near its low, it's a breakout below a parabolic wedge, and we might go a lot lower. And instead, disappointment 49, sellers above 50, and then buyers below 51, doji bar, bad low, one short. 52, a bear bar. But again, I think if we were going to collapse, 49 is a big bear bar as well. And so this indicates a trading range to me. So I'm now looking to get long. Big bull bar 53. I would not buy above it because you know you're going to get a deep pullback. I wouldn't buy above unless you're buying more below. You can't buy above 53, stop below. You have to buy more if you're going to buy, or just take the buy below. But 53 to me indicates that we're going higher, but probably just not yet because of this. But once I get 53, I know we're probably not going lower. 54, a bear bar closing near its low, but probably buyers below. Disappointment, 55, and then buyers below 56, a reversal up. Disappointment inside bar 57, possibly bears buying back shorts at the 54 low. Basically, you're waiting for the bears to start to give up, and that's what happened, 59, 60, 61. Like I said, I bought up here. Wasn't the worst. I wanted to get up here, but my calibrated expectation, I probably could have done a little better. I probably could have exited somewhere in here. I don't think it was a terrible buy, though. But 62, bear bar closing near its low. It's a possible third leg up. 1, 2, 3, and an expanding triangle. I didn't notice real time. Happens sometimes. So sell off to the downside. Another 4-bar micro channel, which does end up getting the measured move, but not really an ideal trade. And then you can see sold off 73, big bear bar closing near its low, and buyers when you get that sort of sell climax. So the daily chart, well, it kind of depends what daily chart you're looking at. I'm just going to look at the regular trading hour daily chart for now. But to me, that means it's probably a little bit less of a bear trend and probably a little bit more of a trading range. Still, we should get back to this area. This isn't going to be one of these situations where we rocket straight up from here. This is probably the start of a trading range within a couple hundred points. It's possible the trading range start is somewhere down here. So 1, pullback, 2, pullback, 3, 1, pullback, maybe 2, somewhere down here. Wouldn't be surprised if we got a bear channel down to this area. But one of these higher lows, for now it's this one. This one's a little more major, but one of these higher lows is going to be support, and it's going to make us go sideways. The weekly chart, a big outside down bear bar, it's going to need a second leg. So again, I think we're going to go a little more sideways. It's possible spike, pullback, bear channel, but the bull channel, but the bull channel is a little too tight, so I'm not really sure. And the monthly chart, doji bar so far. So there's not too many trading days left in the year, so I'm not sure how many more videos there's going to be. But anyways, there will be a few more videos next week, and then eventually, the new year will start, and it'll be back to the normal schedule. All right, that's the